As I said from the outset, we've witnessed some monster moves to the upside this week. But you know what? One of the biggest winners for the Charitable Trust came from a company called GE Healthcare Technologies, medical device business that was spun out of General Electric a little over a year ago. After trading sideways for a couple of months, GE Healthcare came out on Tuesday and reported a magnificent quarter. It was an 11-cent earnings beat off a $1.07 basis, higher than expected sales for 3 out of 4 divisions, organic growth of 5%. Analysts were looking for almost half of that. Even better, management gave you a very strong full-year forecast, which is why the stock jumped nearly 12% on Tuesday in response. And you know what? I think this is actually just the beginning of the move, hence why we own a huge amount of it for the trust, something you know all about if you belong to the CNBC Investing Club. But do not take it from me. Let's check in with Peter Arduini. He is the president and CEO of GE Healthcare Technologies. Get a better sense of these numbers. Peter, welcome back to Mad Money, and congratulations on a great quarter.
Hey, Jim. Good to see you.
Good to see you. When we talked to you last, I thought you laid out an unbelievable view. It was just so good. It's your first year as a public company. You basically predicted many good things. And sure enough, positive organic growth you just announced, gained market share, stock flew up. Can you give us what has changed? What have you been able to do in your first year that maybe you couldn't do at GE? Because things are really coming together for this company.
Yeah, thanks, Jim. And it's always great to be on your show. Look, I mean, a lot of it is the premise of 3 separate companies out of General Electric. Focus is a lot. I mean, we have a very focused board. We have people coming to us that really are dedicated to healthcare. And then we've been able to free up our own balance sheet to invest across the company. I mean, those are really at the core of it.
Well, to me, you've also been able to embrace artificial intelligence in a way perhaps you might not have been able to be if you were still in a larger conglomerate. Why don't you tell us some of the things that you're doing? Because to me, this is the real value added you are bringing right now to doctors, to patients, to hospitals at this very moment.
Yeah, Jim. So to that balance sheet point, to be able to do double-digit investments in R&D, which we did this year while still driving up our EBIT rates, it is a lot going into digital and AI. And to your point, there's a couple different areas of it. I mean, the first is AI inside, if you will. So our MRIs, our CTs, our ultrasound are all being greatly enhanced with AI algorithms that either help make the image better, so better diagnosis, better productivity for the user, or actually making it so new users can use the device. As an example, handheld ultrasound. And in all those cases, customers are willing to pay more, bringing up better margins. The second area is, healthcare is full of all types of data. The challenge is it's not used that much. And so a big part is actually how do you form that data for decision making? And we have products like Command Center, which is actually helps a hospital run their system more effectively. And then the last piece, which we're assembling now and will evolve in the next few years, is what's called multimodal data integration. Your genomics information, your pathology information, your image data, all together on one pane of glass, and a given algorithm or foundational model that can help decipher through that data and help your clinician move you in the right direction. And so those are all the kind of exciting things that we're investing in right now, Jim.
Now, Peter, you're in a dogfight. There are others in your category. I think these are real differentiators that create a moat for you. How is business in general, both in the U.S., overseas, and China? Because all these things play a role in how you were able to have such a nice upside surprise.
Yeah, look, I mean, we've obviously had a very good first year. We put up 8% organic growth with all the things that are going on when you're coming out as a separate public company. But again, in the one word focus, we were able to enable that for the team. And I think really with our investments in R&D this year, we've had a really nice pipeline of 40 new product introductions, all of those products coming out with better gross margins than their predicate product. And so those things start adding up. They're a flywheel effect. And I would say, if you looked at the previous years in 22 and early 23, there was questions with rates going up and hospital P&Ls maybe not being as strong as they've had been in the past. We started to see in the second half of this year via direct discussions with our customers and surveys that their P&Ls were strengthening and they were having more confidence to invest in capital. So we were the beneficiary of that. We had a nice strong Q3. And then the great part about that is that parlays into 24. So I start 24, our team does, with over a $19 billion backlog. That really sets us up well. Outside the United States, I think Europe is moving along well. We've got a lot of growth in Southeast Asia. China's an interesting one. It's a country of 1.4 billion people. 400 million have good health care, about 1 billion don't. So there are plenty of opportunities to grow. But I think this year it's going to be a little bit more cautious as we move through the year. We had a tremendous year in 23. I think our first half was over 20% growth. And so, as I said on the call, we're expecting first half to be negative growth and then resume to positive growth in the second half. That's for China. But overall, we're delighted with the macro, I'd say, relative to our space.
And I think the analysts are finally catching up to that. I felt like that you and I were the two who believed, and now they're all scrambling to get ahead of it. Now,
you were a big supporter through all this, so thank you.
I hate to say it, but I've been a big consumer of it. I was the chief spokesperson for the American Brain Foundation, and we know that Eli Lilly is about to come out this quarter and get the word from the FDA about Alzheimer's. And the people at the Brain Foundation told me over and over again, the system cannot afford everyone just saying, listen, I want this treatment. So you're going to probably need MRIs and no family history. And if the MRI doesn't show a problem, you're not going to get these Alzheimer drugs. How important will GE Healthcare be to actually save the system? Because we know the system goes bankrupt if everybody decides that they don't want to have, they're going to stop Alzheimer's in its tracks, even if they don't need to.
Yeah, well, look, I think the first part is, Jim, as you and I talked about, the fact that these new drugs are coming out is a big opportunity for patients in a world where there hasn't been many options. So we start with that. And then secondly, as you know, I've mentioned before, we're a facilitator to help the right patients get the right therapies. And it starts with our PET CT and the actual imaging agents, a product called Vizamyl that actually helps quantify the amyloid beta plaque. If you have the adequate level relative to what the indication is, it's going to be pretty clear who should actually move on to the drug. And then, as you know, we play a role after each administration with an MRI to make sure that any potential side effects are managed appropriately and so that the patient can move forward. So, you know, we're working with health systems as they're thinking about their strategies of how they want to work through this. And, you know, we would expect to see this probably start to beginning to pick up in the second half of 24.
One thing, you have a consumable business. I mean, you have contrast agents. You have things that make it so that you've got a regular, this is something that the analysts are just discovering, regular streams of revenue coming from not just the hardware.
Yeah, no, exactly. I think, look, broadly, over 45% of our revenue is reoccurring. A lot of that is big multi-year service contracts. But to your point, in our PDX, pharmaceutical diagnostic business, we have contrast agents that are used in all types of vascular or heart procedures. And then this whole area of molecular imaging. And again, this is just really beginning to take off. The product I mentioned for Alzheimer's would fit into that zone. But as you get into other oncology imaging and cardiology imaging, those will be really interesting molecules to drive our growth. And to your point, they are reoccurring assets.
Well, look, the story is terrific. You delivered entirely. You have one of the biggest gains that I've seen of a newly public company. Oh, of course, overshadowed today because of ARM Holdings. I'll take what you did any day of the week. Peter Arduini is the president and CEO of GE Healthcare, GEHC, a charitable trust name. Thank you so much, Peter.
Thanks, Jim. Appreciate being on.
I know it's hard to find inexpensive stocks. Believe it or not, even after the move here, this stock is much less expensive than any of its peers. GE Healthcare. Mad Money will be back after the break.
Coming up, ARM is hammering. Cramer takes you behind the stock's rocket-fueled day. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.